All right, let's talk about it all. Our closing bell exchange for a Friday. Quincy Crosby from Prudential Financials with us. So is Ken Mahoney from Mahoney Asset Management. Eric Ristabin from Russell Investments. Ron Mullenkamp from the Mullenkamp Fund, and our own Rick Santelli. Quincy, our Bob Pisani has this adage. It's really significant when the stock market's following the bond market so closely. And, you know, stock traders have been like a laser beam on the 10-year yield. And you're sort of dismayed that it does hover around 260. You think it should be higher, right?
Well, you know, the 10-year is the embodiment of, you know, better economic data, worse economic data, geopolitical concerns, but also what the Fed is doing and how many treasuries are being auctioned off. The other thing is we're seeing that foreigners are picked up buying in the 10-year, which is pushing the yield down. That said, we think if the economic data continue to pick up, we will see a more cyclical tone in this market, almost regardless if the 10-year can't start pushing itself up.
You know, we talk a lot about valuation here, whether it's parts of the market overall, and it looking frothy. But Eric, Jeff Gundlach's out there saying corporate bonds are the most expensive he's seen them in his career. Would you agree with that? And if so, what choice does that leave for investors?
Well, they're not cheap. So if you're going to own corporate bonds, you're going to own them because you have a running yield advantage, obviously, over treasuries. And we think that's actually a fairly safe thing to count on in terms of incremental return. But, you know, you're late in the cycle, well, later in the credit cycle at this point. We think it's got a lot more room to run. But what we're expecting is basically a flat spread environment, not a lot of price appreciation.
You think, though, Eric,
corporate
I'm
bonds,
sorry, I just want to stop you there, because that's a fascinating point. So even though we're already seeing these incredibly high prices in that space to some extent in the stock market, you think we're not even anywhere close to the end? In other words, that they're going to get more and more expensive here?
No, I don't think they are. I think they're going to kind of remain on a relative pricing, meaning the spread is going to stay pretty stable. But we're a long way in our minds from a recession, and really major moves in the spreads, you're going to need some kind of major economic slowdown or major recession to get them to blow out or even increase meaningfully. We just don't think that's likely. Clip the yield.
Ron Mullenkamp, we know you're a great value investor. You're always looking for value, and you are here to pound the table, not on stocks, but on natural gas, right?
Well, yeah, we see no value in bonds. You can find some value in stocks. When we broaden our horizon a little bit, natural gas is still the no-brainer. Gas is selling for about half the price of crude oil, so anybody who can shift from burning crude or gasoline or diesel or anything based on crude to natural gas, we think that's a good play, probably for a half a decade or more.
Do you buy stocks that play in the natural gas field?
We own a little bit of the drillers. We own some of the people who do the service, including the frackers. We're looking for the people who do the distribution, primarily clean energy there. People who make engines for trucking. Trucking looks to be like the next teed up, that and rails. So we're trying to have a leg in every piece of this. In every piece of this play.
You know, we've seen a spike in natural gas prices. Of course, that was back February, March. You can see it on the screen there as well when the weather and the climate were so cold across this country, Ron. So where do you think the natural gas price is headed longer term in order to justify people getting in at these levels?
We think gas will be $4 plus or minus a buck. That is between $3 and $5 for a decade or more. So we're
Wait,
not
and you're saying that's a reason to be long? Because it's already at 4.5 right here. Can people afford to capture what is going to be the upper end then of that spread?
I'm not betting on the price of gas moving up. I'm betting on the price of gas in this range being half the price of crude, so all the people who can benefit from using more volume of gas. We're betting the volume of gas that gets used because the price remains in this area. So I'm not betting, we're not buying natural gas futures, for instance. We're buying all the people who will benefit from the switch from crude to gas.
Okay, great.
Ken Mahoney, you still do like stocks. What takes us higher? What do you like right here?
Well, you know, this is like the Energizer Bunny market. It keeps going and going and going. And it's got to be frustrating to bears. I mean, you know, look at the headlines they have to work with. I mean, every day it's Russia, it's China slow down, it's the Fed tapering, and yet the bears really can't get the claws into this market. And it's good for investors not to be focused on headlines here anyway. I mean, never it's helped, you know, them look at their investment strategy or, you know, the direction of the market when they're looking at the headlines. Look, the last couple of years, you know, those headlines have been pretty ugly with Syria, you know, the government shut down. the credit fault debacle that we had. So for investors, they shouldn't look at all that noise. They just kind of look ahead and say, earnings are going to be pretty good, interest rates are pretty low, and while the seeds are kind of choppy, there's an upward bias to this market.
Looking across the dashboard here, Rick, the dollar index is moving higher today to the tune of about 0.5 point. Is that a good dollar rise or a bad dollar rise?
Everything is counterintuitive, moving in counter trend measures. You have steepening of the yield curve for the last couple of days. You have the dollar index doing better for the last couple of days. But look at these long-term charts. Look at one-year charts of 10s, 30s. I'm sorry, they just don't look like yields are going to be going a lot higher. They look like flat to lower. Dollar index, the last chart for 1 year, it's still bumping along. It's still comping very close to minus for the year based on where it closed. The dislocations in the marketplace, I think, make some of these moves very difficult to predict, more difficult to explain, but I'll keep it simple. I think when you look at the ECB, they've really painted themselves in a box, and there's a lot of knowledge to draw from it. Why would they want to go into negative interest rates? Does that portray the type of healthy economy that most analysts have been harking in Europe? And if it's about disinflation or deflation, I'm sorry, I'm not buying it. I think that is crazy, is not using the natural gas, and I think when the politics change, that gas is going to be the fifth head on Mount Rushmore. Natural gas is going to change this country.
Mitchell, you're going to put up there.
No amount of flat earth politicians is going to dissuade the public for what makes economic sense and jobs.
Now look, Rick, at some of the chemical companies and other big users of natural gas who are a little bit worried that we start to export a bunch of it, the price rises to global standards.
You know what? Wait a minute. This is the dumbest argument as well. If we wouldn't have started exporting food 2 generations ago, we'd have never seen the type of productivity we've seen in agriculture. Exporting energy will just build. It'll build all the technology, and it'll build the industry to be better for everybody.
Go ahead,
I'm trying to picture what a head of natural gas on Mount Rushmore would look like, and I'm coming up with nothing too pleasant.
Quincy Crosby, don't you really want lower yields like for the 10 and the 30? Because if they were to rise, that provides competition for stocks. I mean, you want a lower yield in the bond market so you can be more attracted to stocks, don't you?
Well, you do to a certain extent, but what you don't want is the 10-year yield telling you that that the economy is never going to pick up. That's not what you want. And as long as the market is focused on that, it is what it is. We deal with the cards we're dealt. Mind you, the one thing we do not want is that 10-year yield to move up dramatically or markedly, suggesting that the Fed is behind the curve. That would be the worst thing for both markets, and we're not there yet. But if the data continue to improve and we don't get a sense from the Fed that they are going to talk about rates rising or talk about maybe speeding up QE, the market is going to be wondering what on earth are they doing?
Eric, we got to go, but just real quick, the Russell 2000 is points away from being in correction territory. Is that an opportunity or a warning sign?
I think what this correction is, it's an intra-market correction. Expensive stocks are coming back to earth. We don't think it's a fundamental correction in the Russell 2000. We think it's actually going to continue to move up from here as it consolidates.
All right, folks, thank you. Happy Friday.
Yeah, have a great weekend,
Mother's
everybody.
Day.
Oh, yes. Happy Mother's Day to all mothers as well.